Hello and welcome to this section on retirement plans. Saving for retirement is an investment objective shared by virtually all investors wanting to establish that nest egg for later on down the road when they want to enjoy their golden years. We're going to review the various types of retirement plans that an investor may set up, a number of corporate plans that may be set up for the benefit of an employee, as well as the tax implications of the various plans. It's an important place to start our review by comparing and contrasting qualified plans and non-qualified plans. With a qualified plan, the contributions qualify for pre-tax contributions, meaning the money goes into the plan before taxes are taken out. With a non-qualified plan, money goes into the plan after taxes. Both plans, qualified and non-qualified, allow the growth in the account or the plan to accumulate tax deferred. The money is not taxed each year. When you have a corporate plan that is qualified, everyone must be allowed to participate. And when you have a non-qualified plan established by a corporation, the company can choose who they wish to participate in the plan. IRS approval is required for all qualified plans because the contributions are made with pre-tax dollars. The IRS has to say, yes, this plan does meet the requirements for the participants to make contributions with pre-tax dollars. IRS approval is not required for a non-qualified plan. The cost basis in a qualified plan, if all contributions are qualified, is zero, meaning all money will be subject to taxation when it is taken out from the plan. With a non-qualified plan, the contributions to the plan create the cost basis. Therefore, only the growth portion of the account will be taxed when it is withdrawn by the participant upon retirement or any other event. So when you take money out from a qualified plan, it is 100% taxed. It is taxed as ordinary income. Regardless of how the money was accumulated over time, it will all be taxed as ordinary income. With a non-qualified plan, only the growth is taxed as ordinary income. The investor's contributions are returned to them tax-free because they've already paid taxes on that money. One of the main types of qualified plans that an individual may establish for themselves is a traditional IRA. With the traditional IRA, contributions are made with pre-tax dollars, meaning the contributions that someone makes into their IRA can be deducted from their tax return. The maximum allowable contribution for an IRA is 100% of earned income or the annual contribution limit, whichever is lower. In order to contribute to an IRA, an individual must have earned income. They may not use passive income as a way to fund the IRA. The only exception to this rule is for a non-working spousal option. If someone has a spouse that does not work, they may make a contribution to their own IRA, and they may make a full contribution to an IRA for their non-working spouse. This is the only exception. Once that money goes into that IRA for the non-working spouse, it's deemed to be his or her property. And the person who made the contribution may not make investment decisions for that non-working spouse IRA unless they have limited power of attorney or discretion over that account. With a traditional IRA, the growth accumulates tax deferred, and all the money that comes out, if all contributions were made with pre-tax dollars, will be taxed as ordinary income. There are a couple of different rules and regulations you need to know about withdrawing money from a traditional IRA. If somebody makes a random withdrawal from a traditional IRA before the age of 59 and a half, they'll be subject to a 10% penalty tax. So they will pay ordinary income taxes plus a 10% penalty. So a very large percentage of that withdrawal would go to the IRS. Required minimum distributions, or RMDs, must be made by the time the participant reaches 70 and a half. And the rule says by April 1st of the year following the year, the individual turns 70 and a half. The IRS wants their tax dollars now. Therefore, if they do not take the required minimum distributions, the IRS is going to subject them to stiff penalties. If based on the value of the account and the life expectancy of the individual, the IRS feels that they should be taking out a minimum of $10,000 per year, and the individual takes no money out of their traditional IRA, their penalty will be 50% of what they should have taken out. So in this case, the individual was required to take out $10,000. They didn't take anything out, and the IRS taxed them 50% or $5,000. So failing to take those RMDs subjects the individual to a 50% penalty tax. An excess contribution, if you put more money in an IRA than the annual maximum limit, the IRS is going to charge you a penalty tax of 6% per year for each year that overage remains in the IRA. So this is a nice review of the features of traditional IRAs, and let's take a look at Roth IRAs, which are a type of IRA, an individual retirement account. However, they are operated very differently. A traditional IRA is a qualified account. Money goes in pre-tax dollars. A Roth IRA is a non-qualified account. Money goes in after tax dollars. The maximum contribution for a Roth IRA is also 100% of earned income to the annual contribution limit, whichever is less. The money is allowed to grow tax deferred, and upon withdrawal, should it be subject to tax, only the growth portion would be subject to taxation. The Roth IRA, because it is a non-qualified account, unlike the traditional IRA, is not subject to RMDs, required minimum distributions. Now, there are some special considerations for a Roth IRA. If when the investor begins to withdraw money from the Roth IRA, if that account has been established for at least 5 years, the individual is allowed to withdraw all of the money tax-free, meaning they can get the growth tax-free as well. Now, with a traditional IRA and with a Roth IRA, any amount you contribute to a traditional IRA reduces the amount you can contribute to a Roth IRA in that particular year, and vice versa. So you can't make the annual contribution limit to a traditional IRA and also make the annual contribution limit to a Roth IRA in the same year. You would have to split up the annual contribution limit among the two accounts. Now, what if someone wanted to convert their traditional IRA to a Roth IRA? They can do it. The test point is the amount that they convert is subject to ordinary income taxes, but not penalty taxes. So if an individual converted a $20,000 traditional IRA to a Roth IRA, that $20,000 would be subject to income taxes, but not the penalty tax if the person was under 59 and a half. Now let's take a look at two terms that give test takers some confusion, because the way we use these terms in the real world is different than they're actually meant. A rollover versus a transfer. With a rollover, the individual takes possession of the money. For example, an investor could call up their registered rep and say, "Hey Bob, what do I have in my IRA? You have 100 grand in there. Great, sell everything, send me a check, I'm buying a boat." The investor takes the possession of the money, they can spend it. Now, once the investor receives those funds, they have 60 days to get that money back into another qualified plan. If they fail to do so, they will be subject to ordinary income taxes, and if they're under 59 and a half, a 10% penalty tax. An investor may only roll over their traditional IRA one time per year. This is the textbook definition of what a rollover is. This is not how we use this term in the parlance of the industry. Let's take a look at a transfer, which you may be more familiar with. With a transfer, the individual moves their money from custodian to custodian and does not take possession of the money. They may not spend it. They do not have the ability to go out and buy goods and services with this money. It is a custodian to a custodian transfer. There is no limit to how often an investor moves or transfers their IRA between custodians. The funds are transferred directly. And this is sometimes what people call a rollover in the industry, but this is actually a transfer. Make sure you're comfortable with that for your exam. What happens when an individual passes away and leaves their IRA to a beneficiary? Well, if the spouse is the beneficiary, they may continue to own the IRA as a beneficiary, or they can roll the money into their own IRA. If the beneficiary is not a spouse, perhaps a child, well, there are certain requirements regarding distributions from that IRA. There are several options that they can employ to withdraw that money. They could take a lump sum distribution, or they can take a annualized payout over a period of 5 years. If they're going to take our required minimum distributions over the beneficiary's life expectancy, they can do so, and they will receive equal payments during their life. If there are multiple beneficiaries, the RMDs will be based on the life expectancy of the oldest beneficiary. So these are the options for inheriting an IRA when you are not the spouse. You can take a lump sum distribution, you can take a 5-year payout, and you can take RMDs. Those are the ways you can take distributions from an inherited IRA. Now, let's take a look at a couple different types of plans that could be established to save and meet college cost expenses. A Coverdell or an educational IRA. With a Coverdell or educational IRA, the maximum annual contribution limit is $2,000 per year. The money goes in after taxes and is allowed to grow tax deferred. A Coverdell IRA is deemed to be an asset or deemed to be owned by the student, and those monies must be used for qualified educational expenses, books, housing, so forth. A 529 plan is a state-based plan, and a 529 plan allows a family member to contribute a significantly larger amount of money. You don't need to know what the limits are because they vary from state to state. A 529 plan could be established in one of two ways. It could be established as a prepaid tuition plan. Perhaps someone has a young child and they went to New York University or NYU, and they're sitting there thinking, I went to NYU and by God, my child's going to NYU. The father calls up NYU and says, hello, NYU, what is the annual tuition for your university this year? It's $46,000. Great, lock me in. My son is going to be there in 16 years. So with the prepaid tuition plan, the individual locks in the current tuition rate and begins to make payments on that tuition for when the child reaches the age when they're ready to go to college. If the person can't get into the school because their grades don't qualify, well, they'll be allowed to use it for another university, or college. That is a prepaid tuition plan. A college savings account would be established as follows. Well, I don't know where my kid is going to college, but by God, he's going to college, and I'm going to start putting money into this account now so that when he's ready to go, we have a good chunk of money available for those expenses. Now, the money in a 529 plan goes in after taxes. It's allowed to grow tax deferred, and the money may be used for qualified educational expenses such as room, boarded, housing, books, computers, etc. All qualified expenses. If the child takes money out for, say, beer money or some non-qualified expense, well, then it would be taxable, a taxable withdrawal. Now, here is a point that is, rather important when we're taking a look at college applications and college admissions. When a student has a Coverdell or educational IRA, that account is deemed to be an asset of the student, and it is calculated at the student contribution rate for qualifying for financial aid, which is about 20% in that range. With a 529 plan, the 529 plan is deemed to be an asset of the person who put the money in the plan. The person who puts the money in that plan is the owner of the plan, and the child or student is the beneficiary. Because the asset is deemed to be the property of the donor and not the student, when calculating eligibility for financial aid, it will be calculated at a much lower rate of the family contribution rate. So dollar for dollar, it has a much lower impact on the student's ability to qualify for financial aid. So that is a nice test point to keep in mind. The contribution limits to the educational IRA are very low, just $2,000 per year, and the contributions to 529 plans are significantly larger. You're likely to see a couple test questions on the 529 plan on each of your exams. All right, let's take a look at some additional types of plans you're likely to see on your exam. Self-employed unincorporated people who are sole practitioners or sole proprietors would establish KEO plans for themselves as a way to plan for their retirement. The maximum contribution is 20% of their income up to the annual contribution limit. They could also show you the maximum contribution as 25% of their after-tax income. So they could show it to you either way, 20% of their pre-tax income or 25% of their after-tax income up to their annual maximum contribution limit. Now, the test point here is that perhaps a self-employed attorney who has a full-time paralegal, if they make a contribution to a KEO for themselves, they would be required to make a full contribution to a KEO for their full-time employee. So they contribute 20% of their income to a KEO for themselves, they would have to make an equal contribution of 20% of the paralegal's income to a KEO for that individual. So if they have a full-time employee, they must make the contributions for that employee as well. TSAs, TDAs, tax sheltered annuities, tax sheltered account, tax deferred account, TDA. These are established for employees of nonprofit organizations and public sector employees. These are your retirement plans for your school teachers, your 403B plans, the people who work for the town, the mayor, the people who work at the town hall. All of these people would have TSAs or TDAs established for their retirement. Now, I want to highlight a point here. If you see TSA, TDA, or tax sheltered annuity, or tax-deferred account, those are all qualified plans. If you see tax-deferred annuity written out, that is a non-qualified plan. That is an annuity contract that would be sold by a registered representative to an investor who would be seeking income somewhere down the line. So a little bit of a subtle test point there for you. Let's take a look at some of the corporate plans. We have a number of different types of corporate plans that we need to review to make sure you're familiar with them when it comes time for your exam. A deferred compensation plan is usually established by an employee who is a high income earner who is entitled to receive a sum of money, but would prefer to receive that sum of money later down the line after retirement, because they figure after retirement they're going to be in a lower tax bracket and they'll be able to keep more money for themselves. So let's take a look at a little bit of a scenario, and maybe you have a person who is an upper mid-level manager at a tech company, and they bring in a huge project way ahead of schedule and way under budget, and the company decides to give them a $200,000 bonus. And the employee thinks, wow, I'm only 4 or 5 years away from retirement. Instead of paying me this $200,000 now, when I'm just going to give most of it away, why don't you pay it to me after I retire, when my tax bracket will be significantly lower? So a deferred compensation plan is a contractual agreement between the employer and the employee where they agree to defer making payments owed to the employee until some point in the future. It's important to note for the exam that deferred compensation plans are 100% non-funded. The company does not put any money aside. If the company goes out of business between now and then, well, it's likely that that employee is out of luck. Two main types of pension plans that could be established for employees of corporations. You have a defined benefit plan and you have a defined contribution plan. With a defined benefit plan, what is known is the ultimate benefit. Perhaps you're familiar with people who are in law enforcement, and they go in and they serve on the force for 20 years and they get 60 or 70% of their salary as their pension when they retire. Well, that is known. They know what their benefit is going to be. If a corporation was going to establish a defined benefit plan, it would work in a similar fashion. In exchange for your services to the company, when you retire, you will receive 70% of your monthly income for life. Defined benefit plans are very, very expensive for employers to provide, usually only for the highest of the high executives. And the people who benefit the most from a defined benefit plan are the people who earn the most money, who are closest to retirement. The entire investment risk is borne by the employer, the entity that established the plan. If the money they put away into the plan doesn't produce enough income or growth to provide the guaranteed benefit, they have to come out of their own pocket to pay that expense of the defined benefit. More likely, corporations will establish defined contribution plans. With a defined contribution plan, well, what is known is the contribution, not the ultimate benefit. For example, a corporation may say, in consideration for your services, we will match up to 6% of your salary into your retirement plan. So here you have a scenario where the employee is contributing and the employer is contributing or matching at a defined rate. Ultimately, the contributions and the investment experience or results of that plan turn out to be what the benefit is. You do not know what it's going to be. With a profit sharing plan, the profit sharing plan, in order to be qualified, the company must have significant and continuing profits. If the company doesn't have profits, they have nothing to share with the employees. But a profit sharing plan allows the employer the ability to share with the employees the fruits of their results during good times, and allows them the flexibility to not make contributions when the company is suffering losses. 401k plans, kind of a umbrella term used to describe corporate plans. Are they defined benefit plans? Are they defined contribution plans? Most likely they are the defined contribution plans. Now I want to highlight another subtle exam point here for you. A payroll deduction plan versus a salary reduction plan. With a payroll deduction plan is a non-qualified plan. A payroll deduction plan would be established as follows. An employee may contact the person in payroll and ask them to put $500 from each check into a mutual fund account. This would be a payroll deduction plan. A salary reduction plan is a qualified plan. It is established by the employer, and they are contributing to their 401k or their pension plan prior to taxes. A good way to remember this is you receive a salary before taxes and you get your check from payroll, and that is after taxes. So a payroll deduction plan is non-qualified after taxes. A salary reduction plan is a qualified plan, and the contributions are made before taxes are taken out. Now, all private sector pension plans are regulated by ERISA. ERISA is the Employee Retirement Income Securities Act of 1974, and it regulates how pension plans are administered for the benefit of employees. It talks about who must be allowed to participate, who is eligible to participate in the plan, and it is every full-time employee, and a full-time employee for ERISA is defined as 1,000 hours per year, and this full-time employee must have worked for the employer for a minimum of 1 year, and they must be at least 21 years of age. If they meet those requirements, they must be allowed to participate in the plan sponsored by their employer. Funding talks about how money gets into the plan. Does the employer contribute? Does the employee contribute? Do they both contribute? When you establish these plans, you can select a beneficiary. This is the individual or individuals who receive the assets in the account should an employee pass away. And it sets forth vesting guidelines. Vesting is the process by which the contributions made by the employer become the property of the employee. If you've heard someone around the office say, I'm 70% vested, that would mean 70% of the money that the employer put there for them is theirs. They can take it and leave. It's important to note that the employee is immediately 100% vested in their own contributions. They are always theirs. The vesting schedule only talks about how the money put there by the employer becomes the property of the employee. All of these plans administrators are acting in a fiduciary capacity, and they have a fiduciary responsibility to the participants of the plan. When you initially join the plan, you must get that plan in writing, and you have minimum reporting requirements. You must get an update on that plan, how it's performing, at least annually. Now, these administrators are acting in a fiduciary capacity. They need to operate these plans in the best interest of employees. Now, for self-directed pension plans, the employees select the way that the investments are allocated in their retirement plan. Effectively, they select how their money is invested. Now, ERISA under Regulation 404C provides for a safe harbor for plan administrators. This safe harbor protects the plan administrators from being sued by participants if the participants' retirement account does not perform as they had hoped, or God forbid, the stock market crashed. Now, in order for the safe harbor to be in effect, the plan must meet minimum basic requirements. They must have a minimum of 3 portfolios for the employee to choose from. And those portfolios must at least be as follows. They have a safety of principal portfolio for conservative investors. They have an income portfolio, and they have a growth portfolio. These are the 3 minimum requirements. Now, if they have these 3 portfolios or 3 accounts available to meet from the most conservative to the more aggressive investors, and they provide their participants with a reasonable basis to move money between these accounts, should the account of the employee suffer losses because of the decisions of the employee, they may not sue the plan administrators or sponsors simply because the stock market did poorly and they were too aggressive with their asset allocation. So a minimum of 3 portfolios and ample opportunity to move the money between the portfolios. Now let's take a look at a health savings account. A health savings account is usually established by people to help offset the high deductibles related to their health insurance plans. Now, the employee or the employer may contribute to these accounts, and the money can be used for qualified health expenses. It can be used for things like doctor's visits, prescriptions. It can be used to reimburse the employee for money that they laid out of pocket. An interesting test point here is that if the individual wants to use the money in a health savings account to pay for an over-the-counter medication, they must get a prescription for that medication from a doctor. So if you wanted to perhaps purchase some Benadryl, which is an over-the-counter medication, but you wanted to use the money in your health savings account to pay for that, you would have to get a prescription from the doctor in order for that Benadryl to be considered a qualified expense for the health savings account. Now, there are a couple rules in place about how and when health savings accounts can be established. If the person is eligible to participate in a health savings account on December 1st, they may make a full contribution for that year. It's called the first day of the last month rule. Well, the last month of the year is December, so December 1st. If they are eligible to establish a health savings account on December 1st, they may make a complete contribution to that HSA for that year. Perhaps a person just got a new job and now they're eligible for a health savings account. And maybe they got this job in November. Well, they're eligible to participate on December 1st. They may make that entire year contribution. The growth in the account is used tax-free for qualified medical expenses. Money goes in after taxes, allowed to grow tax-free. If it's used for qualified medical expenses, the growth may also be used tax-free. If the owner of an HSA passes away and they leave it to their spouse, the spouse will continue to own that as their own HSA. If the beneficiary is someone more distant than a spouse, perhaps a child, well, then the plan ceases to be an HSA or health savings account. Now, we've just done some great work looking at the different types of retirement plans, the different types of college cost savings plans, and we did a nice review of the Employee Retirement Income Securities Act of 1974. We invite you to review this material a little bit more closely in your text and to take some questions in our test bank. We look forward to seeing you in the next section.